Welcome to another episode of Living Fire. Subscribe now so you never miss out on any of our latest uploads. Let's get into the video. It's one thing to plan for a market crash, but it's something else to live through a severe market decline and come out stronger than ever. Warren Buffett once said that it is wise for investors to be fearful when others are greedy and greedy when others are fearful. This statement is somewhat of a contrarian view on stock markets and relates directly to the price of an asset. When others are greedy, prices typically boil over, and one should be cautious lest they overpay for an asset that subsequently leads to anemic returns. When others are fearful, it may present a good value investment opportunity. Since the price is what you pay and value is what you get, paying too high a price can decimate returns. To elaborate on this, the value of a stock is relative to the number of earnings it will generate over the life of its business. In particular, this value is determined by discounting all future cash flows back to a present value or intrinsic value. Pay too high a price, and the return over time will erode. That is, the one that arises as a stock gravitates back to its intrinsic value. Act greedy when others are fearful, and reap enhanced returns under the right set of circumstances. Predictability must be present, and short-term events that create the subsequent downgrade in prices must not be eroding. So here's how Buffett did it. Cigar butts and Coca-Cola. Warren Buffett is not just a contrarian investor. He may be what you might call a business-oriented value investor. And this means he does not purchase any and all stocks just because they are on sale. Originally, that approach was Ben Graham's style, as well as Buffett's initially. Known as the cigar butt style of investing, this approach picks up discarded business cigar butts laying on the side of the road, selling them at deep discounts to book value with one good puff left in them. Ben Graham looked for net nets, or businesses priced below their net current assets or current assets minus total liabilities. Although Warren Buffett began his investing career this way, in the face of anemic net opportunities, he evolved. With the help of Charlie Munger, he discovered the land of outstanding businesses, the home of See's Candy and Coca-Cola, or KO, businesses with durable competitive economics, the moat, and rational, honest management. Buffett then looks for a good price and takes advantage of opportunities when others are fearful. As he has said in the past, it is much better to buy a wonderful business at a good price than a good business at a wonderful price. Salad oil. Don't leave home without it. The fear-inducing events that lead to superior investment opportunities can include short-term shockwaves created by macroeconomic events, such as recessions, wars, sector apathy, or short-term non-moat damaging business results. In the 1960s, the value of American Express, or AXP, was cut in half when it was discovered that the collateral it had used to secure millions of dollars of warehouse receipts did not exist. The collateral in question was salad oil, and it turns out that commodities trader Anthony D. Angelis had faked the inventory levels by filling his tankers with water while leaving small tubes of salad oil within the tanks for the auditors to find. It is estimated that the event cost AXP in excess of $100 million in losses, according to some sources. After reviewing the company's business model, Buffett decided that the company's moat would not be materially impacted by the event, and he subsequently invested 40% of his partnership's money in the stock. Over the course of 5 years, AXP increased fivefold. The 𝐦𝐨𝐬. In 1976, GEICO was teetering on the edge of bankruptcy, due in part to a business model shift in which it extended car insurance policies to risky drivers, with assurances from the then company's CEO John J. Byrne that the company would revert to its original business model. Buffett invested an initial sum of $4.1 million in the company, which grew to over $30 million in 5 years. GEICO is now a wholly owned subsidiary of Berkshire Hathaway, or BRKB. Shockwaves such as the salad oil scandal and business model drifts create value and have allowed Warren Buffett to reap substantial returns over the years. To be greedy when others are fearful is a valuable mindset that can reap substantial rewards for the investor. Why should investors be fearful when others are greedy? This idea comes from understanding market psychology. Often, investors, especially in aggregate, are driven by emotions like fear and greed. If markets are rising, greed can keep people buying and bidding up prices, hoping for ever larger returns on profits. This, in turn, can lead to asset bubbles, which will eventually pop. So why is Warren Buffett nicknamed the Oracle of Omaha? Buffett is known as the Oracle of Omaha because investors and other financial professionals closely follow his investment picks and comments on the market. But rather than living and working in New York on Wall Street, he famously resides in Omaha, Nebraska. Who will take over Berkshire Hathaway when Warren Buffett dies? Warren Buffett is no longer a young man. He was born in 1930, although he still runs his holding company, Berkshire Hathaway. In 2021, it was announced that Buffett's replacement when he eventually steps down or passes away would be 𝐥𝐤𝐤𝐤. Abel is presently CEO of Berkshire Hathaway Energy and vice chair in charge of non-insurance operations. More often than not, investors lose hope during a bear market to the extent that they may even abandon equity market investments for a long period before getting back to markets exactly at the wrong time. Even though this phenomenon has happened throughout the last century, it seems as if investors are not learning from their mistakes and are hesitant to do the right thing when markets crash. During these trying times, the best way an investor can focus on doing the right thing is by looking at how the legendary investors have achieved their success. Warren Buffett, arguably the most successful investor in history, once said, "One simple rule dictates my investing. Be fearful when others are greedy, and be greedy when others are fearful." It's no secret that there's plenty of fear right now in the market. Therefore, it seems this is a good time for value investors to be greedy. However, this is easier said than done. In this video, we will look at what we think is the correct way to be greedy during a market crash and highly volatile conditions. The cycle of emotions. The first important thing is to have an understanding of the cycle of human emotions. According to behavioral finance studies, investors tend to base their investment decisions on emotional factors more often than they realize. For instance, when stock prices are soaring, investors feel a false sense of security as the media reports these numbers in a manner that attracts new investors and boosts confidence in capital markets. Such actions, however, could lead to dire circumstances. And with that, we've reached the end of this video, all about being greedy when others are fearful. If you enjoyed this episode and found it helpful, don't forget to give us a thumbs up and to subscribe to our channel for more content just like this. Thanks for watching, and we'll see you in the next one.